Hello
Sure.
everyone. My name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. AIF is your alternate investment funds, and PMS is nothing but portfolio management services. So we are a platform. So we are emerging as one of the largest platform for investing in alternate investments and portfolio management services. And in fact, what we are witnessing is huge value migration from mutual funds to AIFs and PMSs of late. So at AIF and PMS Experts India, we run this show called Ask the Expert, where we invite industry experts. We try and read their mind, try and understand what's happening around the industry because they bring some sort of expertise on the table. And with me, I'm glad to share that with me, I had a series of discussion with Apoorva in the past and invited him. And finally, I got his time today. I could manage to get 30 minutes of slot from him. So with me, I have Mr. Apoorva Vora. He's the co-founder at Finvolve Ventures Private Limited. And he is, so he brings about almost 3 decades of experience on the table. And I personally happen to know him and have been following all his data points that they share at Finolution. So Purva, first of all, thank you so much for accepting our request and
Absolute,
taking the time.
absolute my pleasure, please,
Yeah,
Vikas.
yeah. So the whole idea of this show, Ask the Expert at AIF PMS Apoorva, is to educate and empower the investor community as a whole. We
Correct.
we really don't chase too much about products, etc. But what we really tell them that what's happening, and if they can take out some information and take out the time from their busy schedule and try and know more about it, they can take the advantage of that. So idea is to build the
Correct.
AIF and PMS culture in India. That's the
Correct.
thought process. So let me have the privilege of introducing Apoorva. So as I said, he's the co-founder out there at Finvolve Venture Private Limited. It's a joint venture between Finolution LLP, which is of course a business consulting firm for wealth managers and operating from Mumbai and GIFT City, both Gandhinagar. And also the India Accelerator, an award-winning startup accelerator based out of Delhi and presence in Ahmedabad. So they both the organization have come together, and they also have presence in
Correct.
Dubai and Silicon Valley. So the whole collaboration, we will try and read his mind that what was the reason of this collaboration, and then they filed their first product, which is an angel fund. So there are two. There's a difference here. A normal AIF of Cat 1 requires minimum threshold of 1 crore and 2 and 3. But in case of angel funding, it has brought down to 25 lakhs. So we'll try and read his mind today. What was the reason, and is there a rationale that maybe the regulator wants ecosystem to be improved and more number of people to participate in the whole angel funding culture in India. So today's topic is startup as an investment. I mean, that's an asset class. So we talk about that because that is really shaping up well in India. I remember a decade back, the number of unicorns in India were very less. I mean, there were hardly two or three, which is now grown to more than 100. So Apoorva has been doing a lot of studies in this area. So today is a very exclusive and great session that I am looking forward and try and learn more from Apoorva. So Apoorva, over to you. My first
Yes,
question is, yeah. So my first question is, क्या हो रहा है? What's happening in startup industry? Maybe if you can begin from there and then we'll build on it.
So, first of all, thank you, Vikas, for inviting me for the show because you've been doing a great work in your segment, and this becomes a medium for us to share some of the thoughts on one particular asset class today, which is startups. The way we look at it is that, see, in almost no time, India has become the third largest ecosystem for startups in the world today. A lot of people question the legitimacy of 1,14,000 odd startups which are registered in the country today. This number was barely any number, say about 4 years, 5 years back. You spoke about unicorns. Even the number of startups in India were almost like 5,000, close to 5 years back. So what happened in 5 years where the numbers grew from 5,000 to 1,14,000, which is the data as on 3rd of October? So because the first very honest answer to that is that there were startups even before. There have been startups that have happened even before 5 years, and they happen today as well. One big difference that has happened is that earlier startups were not registered under any platform. There was a platform which was created by the government of India by name Startup India. And it is not mandatory for a startup to get registered, but there are benefits of registration. So once a startup start looking at it, there is a benefit of me being registered. Today's startups have started going and registering their businesses in the platform. And therefore, the government now has got data of the total number of startups. If there is no registration platform, how would anybody sitting in Delhi even know what is the total number of startups that exist in India? So while this number of 5,000 to 1,14,000 doesn't mean that startups have suddenly grown, it means that the startups have registered, and now there are more and more startups which are coming open to register themselves. We need to remember that the moment you have registration done once, the government knows which are the startups which are doing what kind of activity. Then the government will be in a position to study the data and look at the pain points, which is where the biggest advantage lies, that now we are a much more regulated environment for startups. And therefore, there are a lot of remedial measures which you will see in the days to come, which is one major advantage. And I will end on one another note. If you look at this year's budget speech of Nirmala Sitharaman, there was 21 times the reference of word startup in that speech. Right? Now, 10 years back, if Indian finance minister was presenting a budget speech, and no offense to any sector, we could have heard agriculture word 21 times, but the word startup would not have come up 21 times. So today the government understands the importance of startups, and that is where the entire ecosystem is looking much better than it was a few years back. So that's my long or short summary, whatever you can call.
No, thank you. You gave us the great insight that now everybody has come together. Now this is a story from unorganized to organized, where you are able to take a glance in terms of how many of them are there and what are they doing. So it becomes easy for external players, foreigners to look at what we are doing, and at the same time, government to see what is the growth recorded by them. The second question is, I think if I can recollect, so been following some data points. US used to be where we are, both in terms of size of the economy in 1981 or 1982 perhaps, or maybe the way they were supporting startups during that time. And they grew from $2.5 to $5 trillion and so on. So do you see the similar sort of situation here, where there is good amount of support coming from regulator, or these supports are only spoken by our politicians and not been shown in the ground? Because you've been talking to a lot of startups before they invest, A, and B, your thoughts on where are we headed? Over to you.
Okay. So because if we were to make comparisons with not only US, but let me make comparison with US and China both now, right? And if you look at both these countries, the way things have moved in both these countries, very interesting data sets for us to look at. If I look at the number of unicorns, US and China are well ahead of India in terms of generating unicorns, because India has done a very late catch-up, right? China was about a decade earlier, and US was about 2.5 decades earlier or 3 decades earlier than India in this space. So if I look at that, I am not too disappointed, for a simple reason that in China, you have close to about 165 odd unicorns. In India, we are at about 110 odd. A 10-year catch-up for us to do, and if that is the kind of gap that we are in, we have covered great distance, is what we say. Now, even better would be if I talk about the investor count or the growth of investors in each of these markets. If I look at the last 3-year numbers, US has been growing at 13% year on year in terms of new investors coming into this space. China, that count is only 2%. India, that count is 37%.
Oh.
Right. So the number of investors who are now embracing startup investments is growing at a significant rate. Though, of course, we need to remember that India's base is much lower, but the speed is now catching up. So we are definitely in a catch-up mode, without a doubt. But even bigger data set for us to look at is the number of institutional investors or funds. All in all, in India, roughly, and this is not an exact number, but by and large, a published number again, is that India is roughly about 2,500 odd institutions which are there to support the startup ecosystem. This is as compared to China, which has got about 5,400 odd, and US is about 14,000. So again, if I look at the absolute numbers, India is lagging behind China and US by a huge margin. But let's understand, the institutions which are growing, that 3-year CAGR growth of India is 31%, compared to US at 9% and China at 4%. So we are growing in number of investors, we're growing in number of institutions. This is making India a very, very interesting sweet spot. Finally, the only area where we are lagging behind, and lagging behind by a good margin, is that, and this is about a 1-year-old data, I'm sure 1 year things would have changed marginally. But of all the money that gets invested into startups in India, nearly 74% of that money come from foreigners. Indian investors account for only 26% of investments in India. But because you've been in this business for long, you know it very well. The same was the scenario with us in the listed equity space about a decade back. FIIs were having much bigger belief in India's growth story than we domestic investors were having just about 10, 15 years back. I'm very sure things will change in startups also in the same fashion. It always begins with institutions. The retail investors follow a little later. The institutional growth is much better. The investors' growth we'll see now. And the retail investors will also start looking at startups in a better way in the days to come. So this is how I look at growth going forward.
Thank you so much for sharing these important data points. It becomes very relevant for us. And it reminds me, like, for example, from 2010 to 2020, almost a decade, when these companies have really become unicorns, so-called. You talk about Paytm, you talk about, Grow, or many other. But इसमें Indian investor का पैसा नहीं बना. I mean, the Indian investor can say कि मेरा Ola 300 times हो गया. I mean, hardly I meet 1 or 2% people like the Ambanijis of the world. I mean, their family offices who can say that only कि मेरा 1%, 1 crore has become now 200 crore. But Ola alone has grown more than 200 to 300 times. That's a story from unorganized to organized. But unfortunately, we as an investor did not play out. So now that, so I've got a lot of questions for you today.
Please.
Don't mind. I'll be asking you a couple of questions. So that leads me to my third question, which is, now you tell us what is going on in regulators' mind when it comes to AIF category 1, particularly A. B, what is the difference between normal AIF and angel fund? B, and what was the reason of having a minimum threshold of only 25 lakhs that gives more, flexibility to investors at the level? So these are the 2-3 questions clubbed together, if you can.
So very relevant question. So let me first highlight, all other kinds of AIFs have a minimum ticket size of 1 crore only as an investment commitment. Now for startups, it is important that even very, very critical for government to ensure that startups actually thrive and do better. Usually what happens is that if you give a 1 crore minimum ticket size as a compulsion, and if I also have to operate in the same fashion as other larger VC, so I call these kind of funds as micro VC funds. If a micro VC fund has to perform just the same way as a VC fund or a private equity fund would be, then you will not be able to develop the angel ecosystem that very nicely. Keeping that in mind, SEBI gave this small concession of making the ticket size to be of 25 lakhs as a commitment. But does that mean that SEBI has given this concession and said, jo karna hai kar lo with 25 lakhs? No, the answer is not that. In fact, if you look at, there are more number of players who are getting into Cat 2 funds rather than they get into Category 1 fund. Because Category 1 fund has a huge operational challenge, which not too many people talk about. And the reason why operating or running a Category 1 angel fund is slightly difficult. So I'll give you a simple example. How is this different than a VC fund? If I'm running a VC fund, I have a mandate on behalf of the investor to build a portfolio based on my investment thesis. So if I come to you and promise that I will invest in growth stage companies which are turning around, which are not profit making today, but likely to make profit within 1 year, we'll filter and invest into those companies. You know very well what kind of companies I will invest in. But then I have the freedom to build a portfolio on your behalf. While SEBI has given us concession for 25 lakhs in Cat 1 angel fund, SEBI has put one thing which is very difficult for a lot of people to operate, which is that you need to take approval of the investor before any investment is made. Which means that if I am investing into a fund with your 25 lakhs of commitment, and if I'm investing into 35 startups with these 25 lakhs, I will have to come to you 35 times and take approval of your money to go into the startup. Which could mean that if I have got 200 investors, I might theoretically have 200 different NAVs for me to manage. Because every investor I need to take a consent from. That is an operational challenge for these kind of funds, because of which a lot of people don't come and enter into this space. Because for this, you need a large operational team and a bandwidth for you to be able to run this kind of fund. There have been instances in the past where somebody would have looked at it in a very smart way, but we always believe that investors should decipher between smartness and sincerity. There are a lot of people who could be smart. So one smart way which have happened in the past is that I take a blanket approval from the investor. If I'm getting 65 pages signed from the investor in name of contribution agreement, there could be one more page which says, I authorize Mr. Vikas Agrawal to take investment decisions on my behalf. Now it's as good as having a power of attorney on behalf of 100 investors. I'll take your consent and I'm done with my investments. Legally speaking, that's not something which is in the spirit of SEBI. And therefore, operationally, this becomes a little challenging. So while there are advantages of a lower ticket size, it becomes a bit of an operational challenge for people like us to run this. This is how this is different than others. Otherwise, it's very much, and that's why no other difference, yes. It's a proper legal structure. There is absolute the same kind of reporting that a fund, Cat 1 angel fund will have to do to SEBI, the same way as they would do for a Cat 2 or a Cat 3 fund. Structurally, there is no difference.
Sure. Can you also talk about the disclosure, the portfolio disclosure, the NAV, how frequently, is there a guideline?
Yes, so unfortunately, this is not a product where you can have valuations on a regular basis, right? So the mandate is that you need to have a once in a year audited report and a disclosure of NAV and portfolio valuation that you need to make to your investors. Now, there are multiple ways in which we have the freedom to express our valuation. So let me give an example. Say I invested in one company at hypothetically 100 crore valuation. Now, within 6 months, 9 months, this company's valuation becomes 200 crores. It raises money from someone else and closes around well within 1 year itself. The day it closes around from external investors and the valuation is validated to be 200 crores, in my dashboard, I can showcase this as my valuation jump proportionately for that company. And I can say that the valuation of this company has gone double.
Right.
Right, which is what I can show on the dashboard. But dashboard is not binding on me, nor from a regulatory standpoint. So if an external auditor confirms that this valuation of 200 crores is legitimate, then he will allow me to put in the valuation report for that particular company. And I will share the statement to you which says your amount of 1 lakh rupee here has become now 2 lakh rupees.
So this appointment of auditor is there any intervention by the regulator or
No,
any reservations from their end?
no. There are no reservations of that kind.
Okay, so it's on the fund house to
It is
decide.
on it is on it is
And
on the fund
to
house.
decide to which. Okay.
Yeah. The fund house decides, the custodian, the fund house decides, the trusteeship companies, the RTA, everything is decided by the fund house. But it is disclosed to SEBI that these are the people who will perform which duties for us. That is disclosed as part of the PPM, the private placement memorandum, as we call, to SEBI.
Sure. Now that takes me to my fourth question, which is valuations.
Yes.
That's a very gray area in Indian markets or
Absolutely.
globally
Absolutely.
also. Yeah.
Correct.
My question is that now, because there are no exchanges where you can actually see the price which is defined by the market. Now, how do
Correct.
I value? For example, if I would have invested in Byju's 10 years back, how would I
Right.
see whether the valuation is $1 billion or it is 10,000 crores?
So it was good that you referred a particular name because it makes me easy for me to talk about. When you get into late stage companies, Byju's, I will call it as a relatively late stage company. A late stage company's valuation is still a little easy for you to figure out because this, unfortunately for education and technology as edtech, Byju's is definitely a leader, whether the valuation is good, bad, ugly. It remains a leader in the segment. But when you are closer to your maturity stage of the businesses, then valuation is a lot more easy. The real challenge of valuation lies when you don't have a single customer and when you don't have any revenue. For Byju's, you can still use certain revenue multiples, certain other business multiples, and come to a number and make yourself comfortable whether you want to pay this kind of valuation or not. But if I tell you that there is somebody who has created a company and he's going to make drones and he's going to do ABCD things, the company is yet to make revenue. The company is yet to have a single customer. The question is, how do you value that kind of a business? So challenge is much more for angel investing in terms of valuation than it is for the late stage valuation. But having said this,
Yeah.
there is a challenge for late stage much more than what it might have for the early stage. And I'll tell you why. If suppose a late stage company's performance falters, you've given a certain multiple, you have certain expectations built in that this company will grow at a certain pace. And if it doesn't grow, it will have a huge impact in valuation because then the entire structure can tumble down. But if I tell you that there is somebody who is getting into a particular business space, and today they don't have customers, but the mobile app is ready, this is what it is. And in next 3 months' time, they will start onboarding customers. If you pay 20 crores to this company, you pay 10 crores to this company, or whether you will value it at 50 crores or 100 crores, you have no idea. Correct? That's a risk. You will only do that basis projection if that whatever the numbers the founders are talking about, if those numbers are making sense, will they make this kind of business in 1 year, 2 years, and 3 years? Basis which I will take my judgment whether what kind of valuation can be given to a company. But it is often said in early stage startup businesses that even if you pay a little extra valuation, if the company does well, it does not make a difference because the companies grow very fast, early stage. If in my business I have no customers, but I start onboarding customers, my mobile app is ready, and I might start making some inroads, I will start having my revenues. So a zero revenue company, the moment it becomes a 1 crore a month revenue company, there is a significant uptick which will happen in valuation by default. Because now the new investor comes in with visibility of revenue of 1 crore a month and takes it forward thereafter. So I took all the risk of making a bet on the founders. I should get the benefit.
Sure.
This is how it operates. Now, if the company doesn't do well, whether I've bought the company at a cheaper valuation or whatever valuation, it's still going to become zero. So valuation doesn't really matter as much in early stage. You have to spot the business idea, the scalability of the idea, the qualities of the founders. Valuation is not the topmost priority for an early stage business.
Okay. Now, another question from an investor point of view. Now,
Please.
you've been advising a lot of wealth managers also. I mean, your previous avatar, I'm talking about at Finvolutions. So,
Correct.
I'm your investor, for example, okay, and you're running a wealth management. This is the question on behalf of my investors. Now, I've been given the choice of Cat 1, Cat 2, which is angel and late stage. What do you think? How should be the allocation between these two?
So because first of all, luckily enough, I'm not an advisor. So it's easy for me to start with this disclaimer because this is a very tough job to do. And my friends in the wealth management industry, I have a great respect because they do this tough job of advising the investors. But if I was, suppose, a wealth manager, and if I was, as a wealth manager, I was supposed to advise an investor, I need to understand the risk profile of the investor before I do anything else. Needless to add, startups on face of it are more riskier compared to venture capital. Venture capital is riskier compared to private equity. Private equity is riskier compared to the listed equity markets. And listed equity markets are riskier compared to the fixed income options. Now, somewhere the investor will be able to make a choice and draw a pie chart of his own.
Yeah, so here the question was assuming that the risk appetite of the investor is same for both the categories. It is only from a wealth creation point of view, given the choice, where do you think the client can maximize the opportunity by generating additional alpha?
Okay, so for this, let me do one thing if I can. Let me share the screen if it is allowed.
Sure, please. Just go to share screen and then it will come up.
Yes, okay.
Yeah, visible.
Okay. So let me speak about the risk factors and rewards and how we as startup investors look at opportunity. I will use this only one slide to explain. If I ask this question to my investor and say, which of these plants you would want to invest in? It's only one question I'm asking. I'm not even telling anything other than this. Most often, people will say that I would want to buy the plant Series D without even checking what is the price of each of these. Correct? So because the investor now is seeing fruits on the plant, the investor will feel safest in that segment. Now, hypothetically, this was a plant which was being sold for 1,000 rupees. Now, my question to you as an investor would be, Vikas, if this plant is available for 1,000 rupees and you are an investor, what will this plant fetch after 5 years? What is your assessment? Your answer could be 2,000, your answer could be 2,500, your answer could be 3,000. Because you are buying something which is matured, and therefore in 5 years it will fetch 1,000 ka 3,000 or whatever. Right? This is how it will work. As a startup investor, I look at these things very differently. I would say that rather than buying a plant for 1,000 rupees, can I buy a packet of 100 seeds for 1,000 rupees? I better plant those 100 seeds. If only 10 or 15 of this reach Series D, what money will I make? Now it is the investor who has to take a call that if those 85 seeds which did not produce returns to you, are you okay bearing that? If the answer is yes, then you invest in startups. If you want each and every company of your portfolio to do well and not die out, please, for God's sake, do not invest in startups. This is my short answer. Now, the way it works is, and the reason why SEBI also has kept a ticket size of 25 lakhs for this, is now an investor can do an allocation game. If an investor's net worth was 10 crores, giving 10% of it to a fund and invest in startups would have been a little challenging mentally for me. But if for a 10 crore net worth, if I have to invest 25 lakhs or 50 lakhs, I'm giving minuscule money and taking the risk with that minuscule money. Can I take that kind of risk for a much higher reward potential? If that answer is yes, you should invest in startups. This is how my answer would be.
Great, great. This really clarifies a lot of points. And I'm representing the investor community here. So I'm
Absolutely,
asking
yes.
you very small questions. So please don't
Please.
mind on those lines because
No, absolutely.
yeah, yeah.
Precisely, that's the reason why with a slide share, I'm showcasing that this is how the mindset of the investor should be
Mm.
before even committing money to startups.
Right. So my next question is, Apoorva, what is the total size of the angel fund today? A, and where do you see? Do you think that this will grow? Because, and why am I asking this question? Is because there are a lot of investors who say that, look, I can participate in startup directly, and there are a lot
Correct.
of legal documents that one has to go through without knowing that also. And then often
Correct.
there is this set of, I mean, they're friends together, coming together, and then they are kind of negotiating with startup and investing in those companies. And there are
Correct.
organizations who are offering these services on individual participation also, as you know.
Correct.
Can you throw
Correct.
some more lights on all these three areas and what should investor
Correct.
keep in mind while investing?
Correct. So, yes, because you are absolutely right. There are multiple ways in which people invest in startups. Essentially, there are four ways in which the investments happen in startups. Okay? Uh, the first thing is if there is a significantly large investor uh, for his or her own domain or otherwise for diversification purpose, can straight away give a sizable money to the startup and be a shareholder in the books of the investors, in the books of the startup, which we technically call a captable investor. That is one mode of doing business. For example, and these are pure examples that we are talking about. If there is an auto ancillary startup from Pune which is getting groomed up, and one of the director of a listed automobile company feels that this is a great ancillary business, and he cuts a check of 1 crore and said, "This is my contribution to your business, and I will also guide you in terms of what your next steps in business should be." That kind of capital is a very, very decent capital for any startup to have, because I have a very good qualified investor who is helping me now. That is what we call a captable investor. Generally comes from very wealthy investors only, and who give sizable money to a startup. Then we see a lot of people who create, like what you just touched upon, who create their own informal groups. Right? There are 3 or 4 or maybe 10, 15, and in some cases we have seen even larger numbers of people coming together, create an LLP, which becomes an investment vehicle for someone to invest into a startup. And then they say that we will invest into a startup directly as an LLP. Yes, you can do that. There is no problem in doing this. But personally speaking, we feel that's not the most ideal way of investing in a startup. First of all, why we say so is because we believe from a regulatory standpoint, it is not a very good thing to do. AIF regulations have been brought out by SEBI clearly to pull the unknown investors' money into a vehicle. And that vehicle can then go out and invest into a company. The moment you create an LLP, you are bypassing the spirit of AIF regulations. And because you don't want to comply with SEBI the same way as an AIF is required to do, you create an LLP and invest via the LLP. Is not an ideal scenario. You can still do that if the LLP is genuine, if there are 2 or 3 or 5 friends who are associated with each other in some legal way, then it is still okay. But we have seen people actually inviting participation from unknown people and say, "Saath mein milke LLP banate hain." That's not a very nice way to do, because someday when this gets into the radar of SEBI, and it always will, then there will be question mark on the legitimacy of those kind of LLPs. So this is one category of investment which we personally do not like at all as an ideal scenario. Now I come to the third part of way in which you invest in startup. Is that there are a lot of syndicates that operate, which are platforms which again in the background use an AIF category 1 license only. But they showcase individual startup ideas to investors. So I might do a show with this group and say there is one particular startup idea which makes A, B, C, D things. This is the reason why we like them. We will get the founder to also come and speak. And after that presentation is done, the audience will take a call and say, this startup is looking good, bad, ugly, whatever. You commit anywhere between, say, 2.5 lakh rupees, 4 lakh, 5 lakh into one particular startup. All this money gets pooled into an AIF structure. Only a category 1 AIF can take this kind of money. We pool all this money, and this money is then given to one particular startup of your choice and invested in. However, the rule says,
No, this can be a good option. No?
right, this can be a great option. But however, the rule says that if you invest in this mode, you have to commit 25 lakhs over a 5-year period, bare minimum. So even though you may be investing only 2.5 lakh rupees in one startup, you will have to build a portfolio of 25 lakhs over a period of time. Right? That's the third way of doing business or investing in startups. Now, in simple terms, this is more like equity broking. I give a research report. You take a call whether you want to invest into this or not. Right? I'm not responsible as an equity broking house. I'm responsible only for the research of that particular stock. Now, whether you buy at the right time, whether you exit, you don't exit, is not my responsibility thereafter as an equity research house. More or less the same thing happens here in this startup. However, exits and all happen together via the AIF route. But that's one way. The final way, which is what is gaining a lot of attention of investors now, is to invest via a fund where you have a fund manager who takes a decision on your behalf and builds a portfolio. Of course, he has to take your approval. He cannot build a portfolio of his own. But I will take your approval, and then the portfolio gets built up for you. This is the fourth way of investing. This is how the entire structure works.
Yeah, this is what I want to talk about. That if you do it on your own, there was a time when you could have bought these businesses from the listed. I'm talking about 90s and 2000 and 2002 onwards. You could have always bought these stocks, listed stocks from the exchange. But those who realize in the early stage that mutual fund is a great vehicle and you get professional expertise, there is a proper research team sitting, identifying everything, and then based on that investing, then those investors have now better experience. They have sort of grown year on year, and they have more confidence in the markets.
Absolutely.
So this that is the reason I asked you what could have been the size of the angel investing in India, and where do you see going ahead?
So I'll tell you the exact numbers of angel investing per se is very difficult for anyone to figure out because SEBI publishes the data of category 1, 2, and 3. But within category 1, there is no segregation of data of angel investing alone, which can give me an idea of what could be the size of the industry. Second thing is that a lot of angel investing happens outside of SEBI's fund mandate also. Say, for example, SIDBI supporting and investing into business will not get captured into a Cat 1 AIF data. And SIDBI is the largest investor in India. Right? So it is difficult for us to get an exact number in that sense. But one thing is for sure, that this industry, so one way of looking whether this industry is growing or not is by looking at the registrations of AIF year on year.
Yeah.
Right. Which gives an idea that how this particular thing is picking up. Now, again, I will use screen share to show one particular slide.
Please.
So rather 2 slides very quickly, one after the other. First, let me highlight and say that if you look at the entire landscape of AIFs, more than 50% of the AIF, and AIF industry, by the way, is almost 2.5 times, little more than 2.5 times the size of PMS already. PMS has been in existence for 25 years now. AIF is just about a decade. And in this decade, this size has become 2.5 times larger than that of PMS. But more than 50% of it is in unlisted space. The listed equity accounts for almost like only 16% in the entire frame of things in AIF. So unlisted space is much larger, is one takeaway that we need to have. Within this, let's look at only the first column of category 1. This is slightly outdated data to the tune of this is only till June. But if you look at this, year 2022, which was apparently the worst year for startups, because you had some of the IPOs from startups that came and hit the market and created a bad name for startups. That year had the maximum number of Cat 1 funds getting registered, highest ever by a good margin. 2023, the trajectory is again very, very positive because 27 AIs registered in the first 6 months. I just extrapolate, we are again likely to be a year with about 50 plus registrations. Anybody who gets a license will generally take about a year, 9 months to 1 year for it to come and hit the market and start raising capital. Which means that there will be a lot of Cat 1 funds which will be now in the market. In a subdued market, when the markets are apparently not so great for startups, you will have a lot more demand which will come from these kind of funds, which is where we believe that what we call the startup winter may not last for too long. Right.
This is a very encouraging data point.
Because one more thing, what is even more encouraging is that even the Cat 2 funds where your VC and private equity funds come from, even that count has grown very well in the year 2022 and growing even in 2023. That means that the angel funds will look at VC funds and private equity funds for exits. Luckily enough, that count is also growing. If that number would not have grown, my worry would have been much more because where will the exits happen? But here, exitability is not that big a risk now when we see that Cat 2 funds are also on a rise.
Yeah, so almost 1,200 AIFs now, close to 1,200.
Correct.
AIFs.
Correct.
Okay. Now, from investor point of view, what should be the realistic expectation? Because if you look at Sensex and Nifty and history of the Indian equity markets, the listed equities on an average have been delivering about 11.5% to 12% broadly, 20, 30, 40 years of data points.
Correct.
And mutual fund to sahi hai. Mutual fund has reached to 13, 14%,
Bilkul.
and even the worst performing mutual fund in India.
Correct.
Now, coming back to Cat 1, what do you think? What should be the realistic expectation as an investor that I should carry?
So, frankly speaking, because the word realistic is a little challenge for me to answer, but expectations I can still share.
Yeah, because you are the manufacturer. You have been talking to all the startups. You've been evaluating them. And you would be looking at some sort of numbers that how much I'll be delivering to my investor.
Correct. So let me give you a scale. And I think this is something which I always speak to audiences that one should keep in mind. If you invest in public markets, the listed equity, your expectation ideally should be 12%, give or take 1% here or there, compounded annually. If you invest in private equity, your expectation should be 16. If you invest in venture capital, your expectation should be 20, ideally. And if you invest in angel investments, your expectation should be 24, compounded annually, ideally. Now, there could be some deviations here or there, right from listed to private equity to venture and angel. But expectation-wise, this is a benchmark, if not an expectation, for anyone to have. That ideally, I should be in a position to generate 24% for the investor. Should be a benchmark of any manufacturer.
So,
having said this,
yeah, please go ahead.
Only one last thing. Having said this, if you look at the data which is published by SEBI and CRISIL together, Cat 1 angel funds have delivered, if I look at a straight line average since 2014 till now, have delivered 37.08% returns compounded annually, post expenses. It has delivered more. I'm saying that the expectation that we should have should be much toned down. Let's not have 37% kind of expectations. Again, one more thing which I would want to highlight. 2014 and 15, even before the word startup was defined by the government of India, those returns were very, very poor. Very poor meaning 14% and 9% respectively. It is only since 2016 every year that startup funds have delivered much better. But when I'm saying 37%, I'm including those 2 bad years even before the definition of startups. If I remove that, then the yields would have been much more to the investor. But let's be fair, let's be realistic. My number, a target number, should be about 24%.
Okay. So my last question, if you can also talk to us about your organization, what you do, how do you select the startups, what's your investment mantra? Just want to know more about your company.
Okay. So when we run our fund, we were very clear on few things. We know that we are talking about an asset class which is slightly difficult or a complicated asset class for investors to understand. So we took one very important call at the very start. We said SEBI allows any AIF to charge up to 2% or actuals towards the legal fees or setup fees that we would have incurred for setting up of an AIF. We said, this is our first fund. We want to really make a brand out of whatever we do. And we said, we will not charge any setup fee to the investor. That up to 2%, whatever the cost is, we said we will bear it on we'll take it on our balance sheet and move on. Second thing is there is an up to 2% of operating expenses, which is generally speaking charged separately to the investor, which is true even for PMS and AIF everywhere. We also took a call and we said we will not charge any operational cost to the investor. The audit fee and everything we will bear on our head out of the management fee that we charge. So there is no extra cost that the investor will pay. We don't want investor to even get bothered about the reconciliation of account statement. I'm not charging anything, forget it. Let's make the entry very smooth for an investor. The third thing that we took care of was we had, with 25 lakhs, we decided we will invest in roughly about 35 startups, give or take 2 or 3 here and there, which means that we want to go slightly diversified in nature and not make a very concentrated portfolio on startups, because that's where you end up taking more risk also. So we said, less risky, well-diversified portfolio is what we will create. From a thesis point of view, we took a call. We said we will have a very strong preference for co-investments. Why co-investments? If suppose because you and I were to invest as laymen into any startup, and if the startup does well, 3 years, 4 years down the line, we have come in as an investor, we want to get an exit. 3 years, 4 years down the line, where do we get an exit? Most often what happens is every one of us, all the investors who come in, will start looking at the respective phones. How many VC funds you know? Call some of the VC funds and say, this is a good company for you to evaluate. Would you want to buy? Now, because the reality is, if individuals come in and invest in startups, exit will become huge challenge. But if you co-invest along with significantly large names, exit becomes much more easy, because if I can't reach Tiger Global or a SoftBank, someone else will. Right? So a strong co-investor. So if you co-invest along with Bloom, you co-invest along with Sikova, you're less bothered. Your due diligence part is also taken care of significantly with these people. Right? So I'm nowhere saying that anyone is perfect in due diligence. But rather than me boasting that I have a 4-member team in my office which does due diligence on startups, will I still be able to match Sikova in terms of ability to do due diligence? The answer is no. So why to replicate something where someone else is better? Focus on your own filters and work on your strength. So we said we will work preferably on co-investments as a team, as a major thematic point of view. Second is, my joint venture partner, India Accelerator, is a significantly large name in the startup ecosystem. Last year, they won India's Best Startup Accelerator Award also. Right? Across geographies, there are multiple setups in NCR, With the government of UAE, there is one accelerator that operates out of Dubai. There is a similar partnership that we have in US, in Silicon Valley. We are in advanced stage of discussions with a couple of other countries. Within India, India Accelerator has opened up in Ahmedabad now, and in the process of opening up in Pune and few other places. Which means that this works more like a startup university. So when you have access to that quality startups in-house, plus the option of looking at co-investments with other partners, became our theme. Finally, we also decided one more thing. Because the biggest challenge that we see for these kind of funds is, besides 2 or 3 partners, there would be 1 or 2 other people on advisory board, and they collectively take decisions whether a startup is good, bad, ugly for you to invest in. Instead of having those 2 or 3 advisory board members, we have done something which is extremely radical. We have a 41-member advisory board spread across 11 different domains. Because you've been interviewing a lot of people. Show me one fund which would have had a 41-member advisory board.
No, nobody.
Correct? What we have done is this 41 members are divided across 11 different domains. Now there is a cyber tech company that comes to us and we have to evaluate a cyber tech company. I don't need to go to 41 people there. I will go to only 4 people who are specialists in cyber tech. The remaining 37 people have no role to play there. But the moment I have an agri-tech company, I will go to agro specialist only and not go to the other people. But you need to have a panel of specialists for every domain. And we will only take decision on investments after a domain comfort has come into investments into a company. Very few funds will be able to boast of this kind of a structure.
Great.
Finally, you have a choice whether, for example, we did one company called, and I don't know how many of this audience is from Bangalore, but a very popular company, at least in Bangalore, by name Samosa Party. It's a very simple company that makes samosas. But somebody who makes very structured samosas and sales about to touch 1 lakh samosas a day, you need to give it to them, boss. They've done a wonderful job. Kalari Capital was the lead investor, and we co-invested along with Kalari Capital into this company. Great investment. But when we showcased this to some of our investors came back and said, okay, we don't want to invest into this company because they also make non-veg samosas. In our fund, we will take that consent from you. If you don't want, for your religious belief or otherwise, if you don't want to invest into those companies, we will make a clean portfolio of your liking.
So those options are doable because you are seeking the consent. At the time of seeking the consent, client can say no to it.
Correct, absolutely.
So how does it work? Like you'll have 27, 26, 27 ideas. One of the ideas, let's say I decide to skip. Then you would look at giving me another idea at the same time?
Correct. Yes, I will.
When you identify.
Maybe generally speaking later, because same time I will be giving that idea to everyone. So that will be a little rollover which will happen.
And what is the tenure you look at generally? I mean, your fund tenure.
Okay, so the fund tenure is 7 years from the final close, which is going to happen in the next about a month and a half now. So the 7-year period is worked out in this fashion. The first 2 years is where investors pay money to us in installments. So while I spoke 25 lakhs of commitment, the investor actually pays only 20% of it now.
To start with. And
every 6 months, I will keep calling 20% of money.
20% of the actual, which is about 5 lakhs.
Correct. So if suppose somebody is committing 25 lakhs, it is like 5 lakhs every 6 months to be given to us. So 2 years is the investment period where we keep the drawdown period where we keep taking money from the investor.
Yeah.
Generally, the exits is something which we can start expecting from the 3rd to 5th year in between, typically from 4th year onwards. So investors should have patience for the year 3 and 4.
Sure.
Then you will start seeing exits happening. As and when there are opportunities that keep coming in.
So from 4th year onwards, you don't prefer to redeploy.
Correct.
And you prefer
we will never redeploy. If at all there is an exit that comes in 6 months' time, we will still not redeploy. We will give the money back to the investor.
Which is very good. Yeah, understood. Okay. I got it. It was pleasure talking to you, Apoorva.
Absolutely great.
More time than
Absolutely great.
what was discussed.
Yes, I didn't even look at the time. It was that great.
Yeah,
Thank
absolutely.
you.
It's absolutely pleasure reading your mind and so much to
Please.
learn from you. A lot of data points, which I'm sure would help all our investors to take right decision, informed decision before they commit
Correct.
with any of the startup
Absolutely. Absolutely.
thought about that. Yeah. So thank you so much. And I also want to thank all the investors who have taken the time out from their busy
Yes, same here.
logged in today. So if you want to know more about it, please reach out to us at aifpms.com. Or if you wish to book an appointment with Apoorva, do let my team know and we'll get this organized. Thank you. Thank you.
Thank you.